with all of our fun things that are happening in addition to getting the license, but there's a lot of good entrepreneurial stuff that we focus on in the on our YouTube channel. All right, here we go. Let's make sure we are not with all of our fun. All right, share my screen here again. Make sure you have your notepads ready to go. We're going to move very fast in chapter 3. Chapter 3, Danielle, is actually just a lot of vocabulary. This is actually all vocabulary, but I'm going to give you the nuggets of things that you need to know. So first thing we're going to cover is policy provisions. When you see policy provisions, I want you to write the word rights and obligations. This is simply just going to say, hey, these are your rights as being the policy owner. These are the things that you can exercise, the options of your policy. So first thing is the entire contract. The entire contract, you just need to write this right here. The entire contract stipulates the policy, copy of the application, along with any riders and amendments. The policy obviously is the what you're going to get in your, like if you were to get a physical copy of your policy, Danielle, you would open it up, and generally on the right side, you would have your policy, and then on the back of that is the original application. So the application you filled out when you're applying for the insurance, that's right there. And then when it says any riders, if you don't know what a rider is an add-on to the policy. Generally, there are some riders that are already included in the policy, but if you think of a rider, I want you to think of it as an add-on, which is going to cost extra money. And then amendments, Derek, that is going to be, hey, you apply for 500,000 of insurance, and after underwriting, you actually got rated. So they would give you an amendment that you would need to sign to make sure, hey, that you agree with the new premium and the new agreements in the policy. So that's the first one. You need to know the definition of that because it's an easy question to get right. The second one is insuring clause. Insuring clause is the agreement set forth between the insurer and the insured. That's what you need to write down. And then next to that, once you write that down, all you need to know is that this is the insurer's promises to pay the death benefit upon the insured. That is the definition of it, is that the insurer, the insurance company, Darlene, promises to pay the death benefit upon the death of the insured. You remember in chapter 1, we talked about unilateral contracts. It's a one-sided party contract. Only the insurance company is legally obligated to pay out their side, because as a policy owner, you can cancel the policy at any time, but the insurance company cannot cancel you. So this right here sets forth the insuring clause that they promise to pay out the death benefit as long as you don't, you didn't lie on the application about your health, you didn't commit suicide, or there wasn't any exclusions in there. The second one is called the free look provision. This right here says that the moment the policy is delivered, Alana, you get a 14-day free look period. They say, hey, listen, you have 14 days to look at the policy. If you don't want it, you can get a full refund. The key points you want to know about it is 14 days of full refund once the policy is delivered. That 14-day activates when the policy is delivered. If you are in a different state than Florida, it might be different. It could be 10 days. Okay, then I understand. Yeah, so you just put that in there. So in different states, it could change. So free look provision. Okay, Daniel, y'all in Georgia? Y'all in South Carolina? I thought y'all were in Jacksonville with us. Okay. Not everybody can be as cool as y'all, I guess. All right. So Free look provision. So the next thing is consideration. You might want to write this called the consideration clause. This right here says both parties come together and they bring something of value. The consideration provision states that one is giving something of value, which is the premium paid and the statement on their application, Derek. And the insurance company is, hey, listen, we promise to pay the death benefit, like we already said. So consideration is more for both parties coming together, but the insured promises to pay the premiums, and they're telling you that your statements are true on there. Perfect. Okay, owner's rights. So when you have a policy, you can change anything about the policy. So let's just say, Danielle, you take a policy out on yourself. You're the one paying the premiums. You can change the amount of coverage. You can change the premium amount. Heck, you can even change the beneficiaries. You can sell your policy if it allows it to. You can cash it in. You can change anything about the policy. You can cancel it. So you as the policy owner, you're paying the premiums. You pay that to the insurance company, and the insurance company is covering you. And the agreement is there, if something happens to the insured, the insurance company is going to pay the money to the beneficiary. The one thing about it is life insurance is one of those products, Derek, you never want to use. No one wants to die. But unfortunately, it's going to happen. It's 100% going to happen to everybody, right? Unless you get with Elon Musk and he somehow puts your soul in a chip and all of a sudden you end up like iRobot over here. Or looking like RoboCop. And you're saying, dang it, now I got to work. You still got to work. Even after death, you still got to work. And they make you come back and re-get your license. So that's the policy owner's rights, okay? So Danielle, there's something called an assignment. When you write assignment, I want you to write the word transfer of ownership. It's transfer of partial or complete ownership of the policy to another. So there's two types of assignments. An assignment, Mia, comes into play when, let's give an example. Let's just say you have what is called you're terminally ill. And God forbid, no, that doesn't work. There are companies out here that will actually buy your policy, right? And this is not your Stoli like we talked about, but there are certain people that will actually buy your policy because, give you an example, whole life policy, you have $500,000 of coverage and you've got $250,000 of cash value because you've had it for so many years. If you say, hey, I don't really need this 500 grand, they will actually give you, let's just say 200 grand, or no, so $250,000 for your policy. And now you're going to essentially assign ownership of that policy to this investment company. And when you pass, they're the new beneficiary. So they just came up $250,000 minus whatever they got to pay into it, right? That is the real life scenario that we'll study here. But absolute assignment is transfer of all rights and obligations. That's what I want you to write down. For absolute assignment, transfer ownership, all your rights. It's permanent. Once you've done it, you can't change it. The second one, Darlene, is called collateral assignment. Collateral assignment is a transfer of partial rights or temporary. Next to that, I want you to write loan. You would generally do this for a loan. And again, you can't do this with term insurance. This would have to be a whole life policy that has built some savings in it. That would be considered some collateral. Otherwise, I'd be taking out $1 million policy, go get a loan, and be like, "Good luck, you ain't getting this back." Catch it when I'm cash out that policy when I'm gone. I mean, maybe my morals are not as good as they should be, right? All right, Danielle. Next part right here is beneficiary designation. Okay, beneficiary designation simply talks about who can get the money. Now, a couple things we want to know. You can leave your money to a person, an entity, a foundation, a corporation, a trust, a trustee. Hey, you can leave your money to your dog if you wanted to. And sometimes you might like your dog more than you like everybody else. Derek, you like your dog more than everybody else? Dang, bro. You got to come hang out with me more. Then you'll definitely like your dog a lot more. All right. So Danielle, when we talk about leaving money to a loved one, when a beneficiary gets the money, the money that is given to them is tax free. The money is not taxed at all, except if it changes, unless it's a transfer of value. Meaning, if you take the death benefit and you invest it into like an whatever type of investment, if that money grows up or whatever that grows into, you're now going to owe money on the interest. But when they give you a check, a lump sum, it's not taxable. Okay, if you leave money to a child, to a minor, they cannot get it until they're 18 years old. I always really caution against leaving money to kids solely because if someone, the question I always ask is, if God forbid something happens to you, who is responsible for taking care of your children? And they say, well, I don't know, or so and so. Well, will so and so inherit a financial obligation? They're like, yeah. Well, it's probably wise to leave some money to them to help out with your kids. Would you agree? And then maybe if you want to leave some to the children when they turn 18, then they can have a little bit at the end of that. If a person happens to leave it to the kids, it's not impossible, but it's a very hard time for the court to give a guardian or the new custodian parent access to the same money. It's very hard. So when you do that, make sure you do it properly. Okay, so this right here, you might see this on the exam after chapter 1 when I told you we weren't going to see that, and then we're going through the quiz and we saw, I'm like, hey, I'm not going to say that no more. So a couple things, Darlene, that you will see on the exam is per capita and per, I don't know how to say that word, stirps, whatever. This simply means, Derek, that if you leave your money to your children, all children equally, they will actually leave it only to your bloodline children. So when you say all children equally, it's only going to those bloodline children.
So not like stepkids?
Not unless you have it written. So they have an example right here. This is a really good example. So, for example, if Brian purchased a $90,000 life insurance policy, he named his 3 children, Quentin, Stephen, Patrick, as beneficiaries for equal shares. But Quentin has two children of his own, Bob and Lou. Steve and Patrick are both unmarried. They ain't got no game. They can't get nobody. So they ain't got no children. And unfortunately, Quentin predeceases Brian. So the money is actually split 4 ways now. So Steve and Patrick are still going to get their own. But Bob and Lou are going to split Quentin's half or a portion. Does that make sense? So that's where just make sure that you name things equally. So that's called per capita. And if this one's called per strips designation, which means by the bloodline, Steve and Patrick would receive $30,000 each, and Quentin's sons would share the allotment of $15,000 each. whoa, hold on. I got ahead of myself, guys. So the first scenario is actually second. It says if Brian selected per capita designation, which means by the head, Quentin is gone. Only two named beneficiaries remain. So Stephen Patrick would get 45,000 each, and Quentin's children ain't get nothing because they're not named as the beneficiaries. Um, that's not going to go in that detail on the exam, so don't look too deep into that. This will be on the exam. This right here says on how the succession of life insurance is paid out. It's primary and contingent. Primary means the first person to get the money, and you can have as many primary beneficiaries as you like. Most people, if they're married, their spouse is their primary beneficiary. Sometimes you don't like your spouse. Sometimes you leave it to your kids. Sometimes you. I've seen it happen. I've seen it happen where husband and wife saying, "Who does money going to?" And they'll look at each other and they set up two separate beneficiaries. They're like, "I'm not getting it." They're like, "No, you'll be all right. The kids are gonna get it." I'm like, "You ain't gonna be married very long, or you might not be alive very long. I don't know which one's gonna happen." That's probably why they probably don't name each other as beneficiary because the other one's gonna take each other one out. And contingent beneficiary, this would be the person who, if the primary beneficiary dies before the insured, the contingent would receive the money. Any questions on that? No, I think it's pretty straightforward, all right? All right. Let's go here. All right, let's talk about the estate. So sometimes on a policy, you might not even name a beneficiary. You might only leave to the estate. So at that point, you're leaving it to the government to give the money to your closest living relative. Like y'all ever seen the movie Mr. Deeds? I'm hoping I got a rich white uncle out there climbing some mountain and leaves me $1 billion. I hope so. And they drop some money off to me. But it would go to the closest living relatives, and obviously they would sort that out. All right. So we've gone through successions of primary beneficiaries and contingents. There's something called a revocable and irrevocable beneficiary. This is a legal term that says, as a policy owner, Darlene, you can change the beneficiary at any time. That would be called a revocable beneficiary. So you say, hey, listen, I could change my beneficiary at any time. But then there's something called an irrevocable beneficiary, where you cannot change the beneficiary unless you have the beneficiary's written consent. So Danielle, let's just say you name me as your beneficiary, and you're like, "Hey, listen, I want to change it to so and so." I'm like, "Nah, I'm good. You ain't got my. I'm not gonna sign that." So if something happened to you, I'm getting the money. That's how it's set up, right? Now, I used to think, well, who would ever use this? It's actually good for business owners. And let me read to you why it works, okay? So when you have an irrevocable beneficiary and a whole life policy, it actually stops that person from trying to take out a loan without your permission too. That's the only scenario that it would make sense to me where someone would actually be willing to give up their flexibility of changing their beneficiary. So right here, I'll use this. So irrevocable beneficiaries have a vested interest in the policy. Therefore, the policy owner may not exercise the rights without the consent of the beneficiary. In addition to being unable to change the beneficiary, the policy owner cannot borrow against the policy's cash value, as it would decrease the policy's face amount until unpaid, or assign the policy to another person without the beneficiary's agreement. That would happen in a business partner situation. Any questions on that? If you were asking what's the definition of irrevocable, it's what I highlighted right there. That's what you would want to write down. All right, we're coming down to the wire on this one. So there's something called the Common Disaster Clause. This right here simply says, well, let me go through the first one. It's the Uniform Simultaneous Death Act. This is where if someone dies, let's just say you have a primary and the insured and the primary in the car at the same time. So let's just say a husband and wife. And unfortunately, they die in an accident together. When they say the Uniform Simultaneous Death Act, and if they can't prove who died first, they're going to automatically assume that the primary died first. So the money is going to go to the contingent beneficiary, not to the estate of the primary. Does that make sense? Hope. Make sure I got that. Okay. I'm just trying to make sure this is true. I'll say, okay, so the Common Disaster Clause, when added to a policy, provides that the insured and primary beneficiary died in common disaster. Even if the beneficiary outlived the insured by a specified number of days, it is presumed that the primary beneficiary died first, so that the proceeds will be paid to either the contingent beneficiary or to the insured's estate. If no contingent beneficiary is designated, most insurers specify a certain period of time, usually 14 to 30 days, in which the primary beneficiary's death must occur in order for the Common Disaster Clause to apply. As long as the beneficiary dies within a specified period following the death of the insured, it will still be interpreted as the beneficiary died first. Okay. Any questions on that? I think it's pretty straightforward on that. Okay. So right here, easy definition. Premium mode is the frequency and how the policy is paid. Premium mode. If you read in the question, it says, which of the following modes describes how something about a policy? You can pay a policy 4 ways: monthly, annually, every 6 months, which is semi-annually, or annually. I quoted a policy today for a client for $5 million, and that thing was going to pay me 30 grand if they within 1 year. So they'll pay me X amount of money up front, but if the client paid up for a year, they would pay me $30,000 in one transaction. I was like, please do that policy. You should do that policy. Let me know when you're ready to do that policy, right? Can you imagine making that kind of money in one policy? Believe it or not, it's out there. Those policies are out there. So premium mode is the manner or frequency that a policy owner pays the policy. Any questions on that? No? Okay. Okay, so the ways you can pay a policy. If an insurer dies during the period. Okay, so there's something called unearned premiums. This right here simply says that if an insured dies during a period of time which premiums have been paid, the insurer must refund any unearned premiums. Have you ever had a car insurance policy and you switched over to another company in between policies? So let's just say you were starting a new policy on the 12th, but that was when the new policy was going to go into effect, and you still had a couple other time on the previous company before you cancel it. I don't know if you've ever done this. If you ever canceled a policy like that from a former company, they actually have to give you a refund of your policies. So if someone dies, let's just say they paid a policy on the 1st and they died on the 4th, the insurance company still owes them the other 20-something days of refunds of what the premium that they didn't earn. Okay, then there's level premium and flexible premium. Most life insurance policies are level premium, which means stays the same there throughout the whole time period. And then flexible premium, Lindsay, is where you can increase or decrease the amount of cover amount you pay into it over the time period. Grace period, you want to know this one? Grace period is the period of time in which you've missed a payment, but the insurance company gives you 30 days of coverage still before the policy lapses. This is a law. Every insurance company does this. The grace period protects the policyholders from losing their insurance coverage if they are late on a payment. So they're still covered for 30 or 31 days after that. That should make you feel safe in what you do. Y'all good on that? Okay. Reinstatement. Okay, so I'm going to give you a couple things on reinstatement. Reinstatement simply means that you had a policy lapse and you don't want to go rewrite a new one. You would rather just do some paperwork to get the policy back in place and start from where you left off. The reinstatement provision has three things. So what you want to write is you have 3 years to do three things. The maximum time limit to reinstate a policy is 3 years. In order for the reinstate the policy, the first thing you must do is provide evidence of insurability. So that's the first thing you got to do, which means you have to answer medical questions. The second thing, Alana, is you are required to pay back all back premiums plus interest, and you may be required to pay any outstanding loans and interest. Again, that would only apply to whole life insurance. If you had a whole life policy, your policy lapsed, and you wanted to get it back in place, you would have to pay back all the premiums you missed, plus the interest. Golly. And then the advantage of. Okay, I guess that was all three. Those I guess I put two. That was three right there. Okay, that was the second one. Pay back all premiums plus interest, and maybe required to pay back all three loans. So I gave you all three, but I listed it too. There is an advantage of reinstating a policy instead of writing a new one. It's because you can keep the age previous that you had it at. So if you wrote a policy at age 27 and 3 years later it happened to lapse for whatever reason, you can actually just reinstate it for whatever it was, and you're still going to pay the rate of a 27-year-old versus a 30-year-old. Your age won't change, so your premium doesn't change. This is one thing you want to know here. If you ever surrender a life insurance policy, a whole life policy, once you surrendered for the cash value, which means you said, hey, I'm taking the money and you're leaving, you cannot reinstate that policy. You have to start a new one. Just remember that. I'm going to go into detail before policy options. Okay, the incontestable period. This is a 2-year period of time which actually helps the insurance companies. Insurance companies can deny a claim within the first 2 years for specific reasons. Let's just say you died within the first 2 years. They are obligated to do an investigation, and they're looking for any material misrepresentation, any concealment, looking for any inaccurate information, making sure that you didn't commit suicide. They're looking for any foul play. They're looking for any of that kind of stuff, right? For 2 years. On year 2 and day 1, doesn't matter how you die. You could have lied on the application. That insurance company is obligated to pay.